Welcome to another episode of Trail Profit, where we help small, mid-sized businesses navigate the world of big business in order to increase their profits or their bottom line. Today, we're going to be talking about business credit worthiness. Specifically, what do banks look at when they are trying to evaluate you and your business for a potential loan? And why do some businesses seem to get fast approval and fast turnaround where some other businesses might lag in getting that same answer? So we'll talk about that here today in the Jeep here at the park. My day job doesn't always allow me to get to the trail, so we're just doing this here at the park here today. So let's talk about how banks evaluate you, your business, and what makes credit worthiness so important. And I think a lot of people say, well, it's about your revenue, it's about your bottom line, can you repay? And that's true. A lot of senses it is. But they also need to know your story, the bank. They need to know that the business is stable, you're stable, you have the ability to repay. Basically, they're looking to see how risky are you and how can they ensure giving you that money is not going to come in at a default or slow pay. How do they lower their risk, basically? And so there's going to be factors that they consider, they look at to help you evaluate to see if they can get to a yes. And if that yes, is going to be risk rated, so you're going to be paying a little bit higher rate because you're a little bit more risky. So we'll talk about a few of those factors that can come about. But basically, going in, the stronger reputation your business has, the better it's going to go for you. And so we're going to talk about 5 different ways here how to build your reputation. And the first thing that we're going to talk about is credit. They're going to look at your personal credit, but they're also going to look at your business credit. So they're going to pull your personal credit just to make sure that, even on a personal side, you're paying your bills, you're saying what you're doing what you said you were going to do, right? Borrow money and pay it back. So that's going to be the primary thing that banks look at. The second thing they're going to do, in addition on this first point, is they're going to pull business credit. So the Experian business, Dun & Bradstreet, what have you. They're going to see, what's your history, what's your business history of getting debt and repaying it back. So if there's any questions on that, you might want to get those addressed if there was an issue in the past. Not that the bank would say, nope, you had this issue in the past, we're never going to lend to you. Things happen, right? COVID happened, the Great Recession happened, so many different things in the last number of years that could have affected your business in some way or another. But how did you address that? How did you correct it? And how did you make it right is maybe what the bank will ask you in relation to business credit. And the second thing the bank is going to be looking at is your cash flow. Certainly, is it positive? But more so than that, are the trends good? Is it consistent? Or are there some red flags? Especially if you bank with the bank that you're applying at, have they noticed that you've had some overdrafts? Have they notice that if you do have a little bit of business credit with them, that you're slow at paying it back? So those are some different things that they're going to look at in regards to cash flow to say, hey, is there sufficient funds there to make us whole? So they'll look at your profit and loss. They'll look at your taxes. If there's any losses on those, just know it's going to be a lot harder to get a request through. The third thing that we're going to talk about here is time in business. Basically, the longer you've been in business, the more reputable you are, the more the bank's going to trust that you can repay them. And the reason why is because not only can your business, having that longevity, seem to handle the day-to-day aspect of managing a business, but maybe you've been through a couple different business cycles. Maybe you came through the COVID and all of that. So being able to navigate different time periods and what they bring about, tariffs, right now, it could really strengthen your business from a history standpoint to say, hey, not only do I have the time in business, but I've navigated all these different things that can make it hard for some businesses to not only stay open, but generate some positive cash flow. Now, in a previous video, we talked about, excuse me, there's somebody passing here. In a previous video, we talked about, if you don't have that length in business, you're a startup. Watch my video on how to fund a startup. We talk about a number of different ways there on how you could get startup capital. And so this video is different from that. This is a video based on you're already in operation, you've been going, and you're just looking to apply for a loan. So that's what makes this video a little different here. The fourth thing that makes you credit worthy or not, believe it or not, is the type of industry you're in. And let's just get the it out there. Restaurants are super risky for a bank, and so if you're a restaurant looking to start a restaurant, if you have an existing restaurant and the restaurant isn't well known, it may be hard to get funding for your restaurant. And the only reason why is because restaurants pose a lot more risk to the bank. And so banks, what they're going to do is they're going to look at what's called NIAC codes, SIC codes. They're going to see, based on your industry, are you riskier than other businesses? If not, why not, right? They're going to look at your financials and compare them to others in your industry to say, hey, are they meeting the standard of their industry, or are they an outlier, good or bad? Bad, of course, is going to make you a lot tougher to get that loan approved. So industry risk is something banks definitely look at, and they do take it into consideration to see if you measure up based on your industry. And then finally, the last thing we're going to talk about here today is your debt service ratio coverage. And basically what that is for the amount of debt you have, do you have enough dollars to cover that debt? And so a good measurement of that banks will often use is a 1.25 times, meaning do you make enough profit of $1.25, for lack of a better scenario, for every dollar that you have borrowed. And so that's kind of the minimum standard for banks that they want to see, is that 1.25 times debt service ratio. It just shows that you have that ability to make those payments. And so just keep that in mind. We'll talk about in the next one of these follow-up videos specifically the financial package you should take to your bank in order to have them look at a potential loan request. These are just factors we're talking about today that bring about credit worthiness. Would a bank potentially lend to you? So, talking about that debt service coverage ratio, it will necessitate that you have good books, you have good clean books, that they're up to date. So just keep that in mind. They'll want to see your books, that they're up to date through month's end, however, quarter end, however you update your books. They'll just want to know that. I might add 6 because I was just thinking about something, and we'll just call this here general items, right? You're going to need an EIN. You're going to need to be registered with the state, city, however they require to be in business for that locality, for where you're at. You'll need to have all that stuff. It would be great if you had a bank account, business bank account with the bank that you're applying at. If not, they'll probably ask you, will you bank with us if we give you this money? So just keep that in mind. Ultimately, what it comes down to is your repayment ability. Does your business have the ability to repay this loan? And I might talk about that in a coming video, is what if you get declined, right? What can you do? Because there are some certain things that you could do to maybe take that no to a yes. And so we'll talk about that in a different video. One thing I would suggest too, even before you go through all of this, maybe even talk to your banker and just say, hey, I'm thinking I'll need money for this, for that, whatever it is. and just say, based on these factors, this is where I think I am. What are some other factors that might come into play? Ultimately, your banker wants to say yes, right? They're in the business to lend money. They're not in the business to say no. And so everything you could do to help them to get to that yes, ultimately is going to be beneficial for you and for your business. So those are just some of the things I wanted to talk about here. 6 things today to talk about credit worthiness and basically how you make your business more attractive to a lender to get those funds. If there's anything you want me to comment on further, explain out a little bit further, just leave it in the comments section. Would appreciate a like and a subscription to our channel here. We try to put out content that's relevant to small, mid-sized business owners. So I hope you enjoyed it, and we'll talk to you next time.